Selling a business in the UK isn't as simple as finding a buyer and signing a contract. There are legal, tax, and timing pitfalls that can destroy your exit if you do not know them upfront. Hi, my name is Boris Sinju, a director at Confabo Industrial Partners. Our team has over 100 years of combined experience and have completed over $1 billion in transactions. That experience has taught us exactly what a buyer would pay a premium for and what kills a deal. In this video, I will go over step by step how you can sell your business if you're in the UK, from valuation to due diligence to eventually closing that transaction. Let's get into it. So data shows that in the UK, it takes between 6 and 12 months for the average business owner to sell their business. However, there are 5 pillars of a successful business sale. One is preparation, 2 is positioning, then the third is finding the right buyer. The fourth is structuring the deal properly, and the fifth is closing and executing this transaction. If you miss any of these steps, you could eventually prolong the timelines that it takes for you to close this transaction. So you might be looking at maybe 8 to 18 months or even 24 months in some cases. However, the worst case is this deal could eventually collapse because the data is not in your favor as a business owner when you're looking to sell your business. I completely understand, you've been working in your business for 10, 20, 30 years. However, 80% of businesses that do go to market will not sell. A third of those businesses that do find a successful, buyer, they will fail during due diligence. And then there's a 50% chance that when you do sell your business, after 12 months of that sale, it might be the biggest regret of your entire life. But why does this happen? It's because business owners do not pay attention or have the opportunity to completely understand what takes place during a business sale. So step 1 is preparing your business. So what does that really look like? As you can see on my screen here, preparing your business is clean financial records for a minimum of 3 years. It's stable or growing trends, documenting internal processes, showing a clear profit margin in your business, and reducing owner dependency. But you might say, Boris, I am just hearing a bunch of phrases and words. How does that affect me, or what does that mean for my business when I'm looking to sell it? So clean financials, what is that? In simple terms, all your financial documents, they have to paint the exact same picture. They have to say the exact same story. So if there's a gap from your management accounts to your balance sheet to your full accounts that you submit to HMRC, people are going to be asking questions, right? Because why would they ask these questions? A buyer has to submit this information to a potential investor, to a potential lender or bank. That's why having clean financials are important, because at the end of the day, it's going to affect your valuation. It's going to affect what you receive when you eventually sell this business. So number 2, stable or growing trends. So what does that mean? You must be able to explain what is happening in your business. Is your business growing every single year? Or is it stable or is it declining? And just because it might be stable or declining, it doesn't mean that it's worth less. It just means you have to be able to tell a buyer, and that buyer should be able to explain what is taking place to his investors or lenders to say, hey, this is what is currently taking place in this business and this is why it's happening. So number 3 is documenting internal processes. So what does that really mean? Remember, if you have ISO 9001, you would have already come across this. So your standard operating procedures. So what that basically means is what takes place during your business, who does that job, and how is it done? And how do you measure if that job has been done to a specific quality standard? So if everything currently runs through you as a business owner, you should be able to document step by step what takes place within this business. And why is that important? Remember, as a business owner, you're going to eventually leave this business. And a stranger who doesn't know your business, doesn't know your staff, might not even know your industry, will have to come in and run this business. And number 4, clear profit margins. I understand we all have certain customers that we might make one-offs for and give smaller, charge them a lower margin because the business is a lot more competitive and they might bring, a bigger revenue in. And we might have another customer that doesn't bring as much in and we need to at least, make the effort worth something, right? So you might charge them a higher margin. But when you're going to market, it is better for you to have standardization. Because remember, if you have standardization, you can show a clear path of how much this business is making in profit every single year, which will support you when you tell the potential buyer, hey, I'm looking for X, Y, and Z for it to be worth selling this business. If one quarter you have 10% margins, the next quarter you have 30% margins, the next quarter you have 5%, there's no true trend like what I was talking about in point 2. So point 5 here, reducing owner dependency. That is so important. We see this happening every single time. An owner is the center of everything that takes place in the business, and they don't even know it. What I want you to ask yourself is, if you were to go on holiday for 6 months and you didn't answer any emails, you didn't speak to anybody, will this business run and still make profits and generate revenue? That's what you have to ask yourself. And if you can honestly say, well, I think this might go wrong, that might go wrong, it means the business is heavily dependent on you. Like I said previously, you're looking to exit and someone's looking to come into your business. If your business performance solely ties on you, your value will not be a premium. You might get lower multiples, which is not what you want. Remember, you've been working on this business for over a couple of decades. So selling your business will be the biggest liquidity event of your life. Don't be the biggest bottleneck. So step 2 is understanding your valuations and the multiples that might affect your business. It's not just profit, guys. It's a bunch of different variables. So for example, like we mentioned before, it's owner dependencies, right? If the business is fully dependent on you, that business will be valued a lot less. If your business is autonomous and it can work without you, that business is a lot more valuable. And then you also have to think about the risks that are in place in your business. Think about your business like a wild animal. You've managed to tame this wild animal, but now you're looking to pass this wild animal to someone that doesn't know its habits, its trends, when it wakes up, when it's hungry, when it feels a bit sluggish. They don't really understand that. And it's your job to be able to de-risk this transaction so you can have the highest and the biggest liquidity event when you sell your business. So when it comes to valuation, I'm going to just, draw a diagram for you guys here. So when it comes to valuation, think about it like a pyramid, right? So the higher you climb up this pyramid, the more value your business is. And it comes from revenue. Okay, revenue is over here. And then it's multiples. Okay, I spelled multiples terribly, but ignore that. So when it comes to multiples, so if your business is here, the part that I'm shading out, which there's a lot of businesses like you. So if you're in the SME space, or if you're doing, let's say, less than £1 million in revenue, or typically less than £5 million, there's a lot more businesses that are, doing less than 5 million. Because why? It's a lot more difficult for a business to start doing 10, 20, 30, 40, 50 million in revenue. It becomes a lot more rare. So the multiples that you can demand goes higher and higher as you climb up this virtual pyramid. So I want you to think about this. If you're a business owner that is in the SME space, which we work with, the only few ways that you can really be able to demand a higher multiple is simply by actually showing up as a better business when you go to market. So your owner dependencies has to be little or nothing has to be there. You have to minimize your risk. you have to show clear profit margins, and that affects your multiple. I know every single time we go, whether it's on the internet or LinkedIn or Facebook or Instagram, you're hearing about a business owner that sold his business for a ridiculous amount of money. And if you did enough research, you might have the exact same revenue he has, but does that mean that you would get the exact same outcome? No. Because fundamentally, the structure that they might have in their business and the market that they're in, it might demand something else. Remember, no two business, regardless of the revenue and the profits, will be valued the same. The difference is the non-financial variables that are in those businesses. So we just discussed valuations, multiples, and you might be thinking, well, Boris, like, what is my business valued at? What could it be valued at? That's why we created this free tool for you that you're seeing on the screen here. So the way you can access this is either by www.confabo.com, or you just click the link in the description and it will take you directly to this page here. So let's say you're a business that's doing £5 million in revenue. And I'm going to mention this word because it's going to affect your whole valuation and how your business is valued. Business is valued at a multiple of EBITDA for easy number sakes, okay? So EBITDA is earning before interest, tax, depreciation, and amortization. But for this scenario here, it's simply just going to be pre-tax profit that we're going to use, because your EBITDA can vary from 8 to 15% of your revenue. This is the core number that every single buyer that you speak to will multiply by. It might be multiplied by 3, it might be multiplied by 4. But in terms of your valuation, all that these buyers are paying for is X amount of years of this EBITDA you'll be paid up front. So if your EBITDA, let's say it's £500,000 and you work in a specific industry. Remember, your valuations go up if your industry that you currently have your business in has a greater moat, right, or higher barrier of entry. Those businesses would typically be valued more. And why would it be valued more? Simply because the room for competition to come in is very slim. Because it's so difficult, there's legislation, there's so much capital investments that take place. So we typically work with industrial businesses because we have industrial experts that we can, work with and just pull on in any case, because we prepare businesses for sale. If you're in another sector, we can always bring another expert to come in to support the process. But let's say you are in precision engineering, right? And let's say you're CNC machining and you're not just general manufacturing, right? You might be in CNC machining, you might be in PCBs, but it's very, very, very specific, okay? Your business will typically be a lot more valuable than a business that's in general manufacturing, that any Tom or Harry can literally come in there, buy one little equipment and start competing against you. So if it's a greater barrier of entry, there are more people that are willing to pay a higher multiple for your business. So if I click general engineering, you can see that the valuations go lower. If I click precision engineering, it goes a little bit higher. So this is a dynamic tool that we've designed for you. So if you could open this alongside us and you're working as I'm explaining, that'll be really, really good if you've got your phone or your laptop next to you. So your staff size, if your staff count, let's say it's 200, plus, of course, it has to make sense with the numbers that you currently have. It does affect the value of your business, simply because a bigger business is a lot more valuable, simply because a bigger business has a lower chance of failure. It doesn't mean it wouldn't fail. It's just that it has a lot more tools and access to resources that a small business might not. And those tools could be loans. Those two could be interest of investors, right? So as a bigger business, it's a lot more attractive. But for these numbers' sake, let's say your business that's doing £5 million in revenue, £500,000 in EBITDA, has a headcount between 11 and 50. The next important thing that we have discussed in point one and point two is owner dependencies. So, for example, if you've analyzed your business and you know that your business is completely owner dependent, you can see how it reduces your value. So the data that we use to actually build this system is an aggregate of the average within the sector, right? So this is not financial advice. This tool is just to give you an understanding of how these variables could affect your valuations, but they're not really off that by much. They're quite close on the ball. But remember, the market only pays what the market believes is valuable. So even if you think your business might be valued at 5 million, the market might not agree with you. So there might be a massive disconnect here. So going back to owner dependency, if it's partially owner dependent because you have a second tier management team that can run the show and you're coming in, let's say, twice a week, great. It can be a lot more valuable. But if your business is fully managed by your second tier team, you're able to command a multiple in the value that a business that is fully owner dependent can't. Why is that a lot more valuable? Simply because your business is a pure investment play at that point. The buyers can see that you've reduced a lot of risk and you clearly have internal processes that I mentioned before, because this business can actually run without you. So if you want to access this tool and play about with the numbers, great. I would welcome you to do that. If you're on this already, I would definitely say click on our negotiation simulator, because what this negotiation simulator does is that number that we just told you in our valuation tools, you can go into a lot more depth about your contract visibility, and it will give you a true reflection or close to a true reflection of what the market might pay for your business. Okay. So step 3 is creating what we call a buyer pack. It's simply a sim. This is high level information about your business. So it's a business overview. It talks about your financial performance for the last 3 years or maybe even 5 years. A customer breakdown by revenue, percentage of the revenue, percentage of profits. Remember, do not disclose who your customers are in this document, because this document is meant for circulation. This document is given to a potential buyer that says, hey, I might be quite interested in a company like this, right? And they want to understand a lot more. And then in this document, in the same, you talk about your operational team. Remember, do not disclose any names, because privacy is very important at this stage. And then you also have to talk about your growth opportunities. Remember, you're looking to leave this business. If you're leaving this business and it seems like you're dodging something, nobody's going to touch your business. So if the growth opportunities, if the things that you wanted to do, if you had the resources, or if you had the time, or if you had the energy on the new markets that you would have loved to go into, please discuss this. Please put this in your sim. Simply because when an investor or potential buyer is looking at this sim, you want them to think, oh wow, I wanted to go this direction. I think this is the perfect company that will give me, that is a vehicle to take me there. So remember, you are selling this business, so you have to package it in the best way possible. Step 4 is finding the right buyer. Not every single buyer that approaches you is right for you. Even if they have the money to give you, there might be certain things that you're looking for as someone that's selling your business. So we're going to go through the 3 buyers, and that's on my screen here. So you have a trades buyer, and this is someone that's already in your sector. They understand your market. They're mainly looking for synergies. So these might be people that currently might be working in your sector or own a current business in your sector, and they're looking to grow through acquisition, because they might want to penetrate a market which you already have, and by acquiring you, they're able to consolidate a specific market. Number 2 is a financial buyer. So this is someone from private equity. Eventually, they're looking to grow your business, quite aggressively because they're looking to sell it in the future and make a significant return on their investment. The third type of buyer is an individual buyer. So this is someone that has their own personal goals, personal motivations. This might be a former operator of a business within your sector, or someone that might be actually just coming into your sector but has enough money or is willing to take the risk to acquire a business like yours. So the most important thing, the differentiator with these guys is they want to be hands-on. They're willing to work the exact same hours that you're working, put as much effort, and also potentially also experience the downsides that you also have as a business owner, where in other cases, these other buyers are trying their best to minimize all these different things in terms of risk, downsides, and things like that, because they've taken massive debts. They have massive shareholders that they have to answer to. Whilst an individual buyer, he's mainly answering to a lender or a potential bank. So the difference between all these different buyers is how much they're willing to pay. So typically, PE or financial buyer, they're willing to spend more money simply because their growth strategy is, we want to buy a lot of these businesses, grow them quite aggressively, and then sell. So if you're a great business, you'll be able to demand more. From a trades buyer perspective, they're looking to pay as close to market value as possible. There might be the odd case where a trades buyer is willing to pay more simply because from the services that they currently have, you might be able to unlock new revenue by them actually pushing the current service to your customers. So that's when they might be able to compete with a private buyer. An individual buyer, depending on their motivation, they might be willing to actually pay a significant amount. So, but what you can understand from what I'm talking about here, it's always down to the buyer. And it's very important that as a business owner, you understand what the motivations of each buyer is, what the vision for your business is, because there's a difference between what they tell you and what they're actually going to do. So understand, where is the finance coming from and who's behind the finance and what's that shared vision or goal, because majority of the time that is very, very important in how they will treat your business post closure. Okay, so step 5 is negotiating the terms and the heads of terms down the line. So number 1 is, when a buyer approaches you, they are going to tell you, hey, we love this business. It's going to be full of excitement because it has to be. Remember, we love this business. We want to find out more about it. And you give them that information. You give them the same. You give them some more information so they can validate that what you're telling them is actually true. And they might come to you, for example, and say, hey, your business, we want to pay you £2 million for that business. And you're like, man, I've absolutely hit the jackpot. But wait there, do not celebrate too soon. You have to understand what the payment structure actually is. Because when someone tells you that headline price, it doesn't mean you're going to get that money from day one. So it's quite important. You have to understand, will this money be structured? Will I get it here, everything on day one, or will it be a little bit, or 60% on day one, 40%, and that's all good? Or is it going to be 60%, 20, and 20? You have to understand what the payment structure will be. And then what's the transition period? How long are you going to stay in the business? Are you going to stay in the business for a year? Are you going to stay in the business for 4 years? You don't know. You have to understand this, because remember, you are passing on stewardship. You're passing on, responsibilities. So if someone gives you, let's say £1 million, £2 million, £500,000, they are not expecting you to walk straight out the door. There has to be a handover period. So you must be quite aware. How much are you willing to tolerate as a business owner? Are you willing to wait 6 months, 1 year, 2 years? And that time will also be dependent on how quick you get your money and what the potential valuations could be. So it's the deal conditions. That's the next thing, right? In step 5, are there non-competes? Are you allowed to start another business in the local area or in the sector? What does that look like? Is it 5 years? Is it 10 years? So you have to understand these conditions that surround the terms of this. And then you're going to go to heads of terms, which is the final valuation. So step 7 is due diligence. Remember when I said in the beginning of this video, 8 out of 10 businesses never sell. And the 2 out of 10 businesses that do go out there, a third of them will fail during this stage. Why is that? Because due diligence, the job of due diligence is to do a deep dive in your business. They want to make sure that the numbers that you've advertised and what you've said, they actually hold weight under scrutiny. Remember this, professionals will be looking at these numbers here. It won't just be another business owner. They hire a team, they hire a legal team, they hire a financial team, accountants, to make sure whatever you're telling them, it matches what is in the documents. So you have financial due diligence. They look at customer concentration. They look at, revenue. They look at profit. They look at all these different variables to make sure that your business is as risk-free as you say. For example, customer concentration. They will look at, where does revenue come from? Does it come from a handful of different customers, or does it come from 3 customers? And if it comes from 3 customers, there's a greater risk, because the question that they'll be asking is, what happens if this customer goes into administration? What happens if this customer doesn't like the business? What happens if you leave and the customer leaves? Remember, they are also factoring risk in the valuation of your business. The next thing is contracts. Do you have contracts in place, or is it more of a pay-as-you-go sort of system where a customer will order something from you and then pay, but there's no written contract to say you cannot leave us for a year or 2 years? I completely understand. There's a lot of manufacturing businesses within the UK that we work with that they have it's almost a goodwill sort of contract. Hey, a business has been working with us for 10 years. They will keep working with us moving forward. And then the next thing is legal. Do you own this company? Are there any skeletons in the closet? Are there any risks that have happened? Are there any accidents that have taken place in your business? You have to be aware of these things, because what the buyer is looking at is, if I buy this business today and I take full legal responsibility, is anything going to come and bite me? So they need to make sure that there are no skeletons, there's no lawsuits that are pending in your business, because all of these things can affect your valuation. So then they look at your operations. So who makes things run within the business? Is your team efficient? Is your team good? So these things are very, very important when you're looking to sell your business, particularly during due diligence. Remember, like I mentioned, if you are the key person within your business, you are the biggest bottleneck. If this business cannot operate without you, it's going to be exposed during this stage, because they will look at every single part of your business, every single moving part. You have to be aware of what is going on. Does your team actually know what they're doing? Or are they just, mannequins and they do everything that you say? And that's going back to what I mentioned at the start. You need to have SOPs, standard operating procedures, in your business, documenting what takes place and how good your people are. I always tell business owners this: take care of your people so they can take care of your exit. If you train your people well and they can run this business, it's a lot more valuable. Do you understand what I'm saying? It's a lot more valuable, because you're able to tell a potential buyer, hey, I'm able to walk away from this business, and there's assurance that this business can run. Okay? So everything in due diligence will affect your valuations, simply because a buyer will factor in risk. They could potentially change the terms, or the deal can absolutely fall through. Remember, due diligence is not just important for the buyer, it's also important for the investors and lenders who will be in this deal, because there's more stakeholders than just you and the buyer, the different bodies and different organizations that you might be hiring and they might be hiring that will have a say in this process. So step 8 is the legal completion. So if you're selling the shares of your business, that is what we consider SPA, share purchase agreement. If you're selling the assets of your business, that is the APA, asset purchase agreement. So depending on how you've chosen to do this, that's up to you. In other videos, we'll talk about what might be right for you, whether it's a share purchase or an asset purchase, okay? And then you go to your warranties and indemnities. So this is where a buyer says, hey, this is what I want to make me feel safe, to make me feel like nothing is going to basically come back and bite me if they find something. And in this warranties and indemnities, they might say, we will hold back X, Y, and Z. I'm trying to make it as simple for you as possible because you did not join this video to get legal jargon. So warranties and indemnities is basically saying, hey, if this does happen post-closure, this is what will take place, right? And for some people, they might not want to hear that because some sellers might say, well, that is outside of my control. Why do you want to claw something back if, we've already agreed on something? But on the other hand, the buyer might say, well, this is a risk that we have to factor. And in any case, if this does take place, we have to be willing and able to protect ourselves, right? And then the fun part is you get the funds transferred into your bank account. And then you have ownership change, which is the legal part where you file the documents to HMRC saying, hey, as the previous owner, I no longer own 100% of this company. This new person, let's say Jim Bob, owns 100% of this company now, and he's legally liable to whatever takes place with this organization. So step 9 is the handover. So remember when we were talking earlier on in step 3 and step 2 about transitioning and about stewardship. This is where it takes place. So if you're a business owner and you've, at this point you've sold your business, there's a transition period where you're going to be passing on a lot of that historic tribal knowledge that you have within your organization. Simply because, like I said earlier on, remember, you are comfortable with taming this beast. You are comfortable with this business, its ups and its downs and how things flow. And someone external is coming to run this business now. So you have to be aware of what that feels for someone else that's coming into your organization. So it might be a year, it might be 24 months. For some people, it's actually 4 or 5 years. If they don't structure things properly or prepare properly, that they have to stay with, this new owner. And majority of the time, that is also tied down to your payment structure. Nobody will ever pay you 100% on day one and agree that, oh, well, you're going to stay for 5 years, right? No, because you've already taken your money and you're thinking about your trip to Spain. That's what you're currently thinking about. So what they'll typically do, what a buyer would typically do here is say, okay, if we're spending 24 months, I will pay you, let's say 70% upfront, and then I will defer the other 30% across the 24 months. And the reason why they do that is to keep you motivated to contribute to the success of the company, contribute to that handover period, right? And it reduces the risk because if something comes up, depending on the warranties and indemnities, they can claw something back, right? And also, if they can't fix a problem, because the business still owes you money, you will be more incentivized to make sure things work. So it works for both parties here. You get what you want, they get what they want, okay? If you found this video useful and you're in your head currently thinking, hey, Boris, I would like to sell my business, but I don't know if I'm ready to sell. I don't know what I'm missing. I need more support. Well, we've provided some free resources for you. Click the link in the description. It will take you to our exit readiness assessment. This is 25 questions that is designed to help you understand where your business currently is across different areas: legal, financial, people, assets, operations. It will give you a holistic view of where you are, and it will give you a number between 1 and 100, if almost like a credit score, if you're ready to sell your business, and where your weaknesses are and how the market might potentially treat you. We've created this free tool for you just to give you a lot more clarity, because we understand the market right now. For you to get proper knowledge or proper support about understanding if your business is ready to sell or selling your business, it's all hidden behind a paywall. So we've created these free tools for you that will give you an indication if you are ready to sell and where your weaknesses are. Remember, the most important thing here is getting a successful exit. But there are many reasons why a business will fail. Remember, like I said in the beginning, the numbers and the data is not in your favor as a business owner, because 8 out of 10 businesses will not sell. A third of those businesses that do find a buyer fail during due diligence, right? And these are some of the reasons why these businesses do not sell. So it's waiting too long to sell. So majority of businesses that we see, the business owners say, well, I'm finally ready to sell. But the business itself hasn't yet caught up. As a business owner, the law sees you and your business as two separate entities. Why don't you see your business as a separate entity? You're ready to sell now, but has your business been preparing? It's typically, the best time is normally 1 to 3 years. That's the sweet spot, because you're able to iron out anything that's in your business that could drastically reduce your value. So number one reason that kills deals and businesses don't sell is because they wait too long. Number two is unrealistic valuations. Guys, I know you want to make a lot of money from selling your business. What we've seen is a lot of business owners, they have put a lot of blood, sweat, and tears into the business. A lot of the time, these business owners, you don't even pay a lot of money into your pension. Are you maxing out your pension of putting 60 grand annually into your pension? Because you can do that. A lot of business owners don't, because they're investing a lot of their earnings back into the business. And in their heads, they're saying, well, my retirement plan is when I exit this business. I'm going to receive a lump sum of money, which unfortunately, when you ask ChatGPT, ChatGPT will give you a very optimistic number. But remember what I said at the beginning of this video, the market truly determines your value. It's basic economics, guys. It's supply and demand, right? And what doesn't really help is, guys, be very cautious when you're speaking to potential brokers out there. Simply because a broker's job is distribution, not transformation. They're in sales. So their job is to tell you what you want to hear in order for you to sign up with them. The question that you should ask a broker is, can I speak to previous people that you've sold their business with or sold the business for? Ask these people, what were the numbers that they initially told you, and what was the numbers that they ended up with? Because there's always a stark difference. We see a lot of business owners, they've been told by a brokerage firm, hey, your business is worth $1 million. And realistically, these businesses are not worth more than $500,000. When you hear a number, a lot of business owners, they stick to that number because it's tied to emotion, it's tied to blood, sweat, and tears, it's tied to effort. But the market doesn't pay for effort, unfortunately, guys. The market pays for sustainability, reliability, and what is proven. So that's the second thing that absolutely destroys and kills a deal, is unrealistic valuation, because you're waiting for that person that will pay you this exorbitant amount of money, and no lender and no investor is willing to back those assumptions or those numbers. Number three is poor financial performance. You don't really understand the financials of your business. You don't really understand your profit margins. You don't really understand where the money is coming from, where you're losing it. You don't understand holistically what is taking place. You can't have one good year and 5 bad years and say, well, only look at my good year. It doesn't work like that, right? And the best way to give confidence is historical data of supporting your assumption or your story. So you must be able to have clean financial, guys. There shouldn't be gaps. You're paying these accountants and you're paying these people within your organization. When it comes to actually, selling your business, these people's value, it starts showing. If you've had a terrible accountant for the last 5 years and they've just been creating your accounts to submit it to HMRC, when you do go to sell your business, a lot of your financial mishaps and a lot of your financial sort of weaknesses will be exposed. And remember that happens mainly during due diligence, right? Which is a very, very crucial stage. So number four is owner dependencies. A lot of people do not take into account how big this truly is because they don't think that they are actually the center of everything. I always say this. If you go on a 6 month holiday with no contact with anyone in your business, can your business still run? Can it generate the profits? Can your people deal with the customers? Can they sort out the suppliers? Can they keep growing the business? And this is why you need to be able to have SOPs. You need to structure things that are taking place in your business. So when you do leave, that tribal knowledge that is in your head, it's actually being passed on to your staff. A lot of people are used to being what I call the superhero owner. So this is you here, okay? This is you. Okay, let me put that there. That is you. So what takes place is every single process happens like this. It comes to you, and then you might flow to customer, you might flow to the supplier, and you might have to put out a potential fire over here. If that's you currently, you have massive owner dependencies. Do not fool yourself thinking your business can run without you because you're at the center of everything. And that's a massive, massive risk because people can say, I love this business, but I don't have confidence that if this person leaves, the business will still generate the revenue and profits that it's currently generating. And lenders and investors also take this into account simply because the question that people will ask is, if you leave, does this business stay the same? And if it doesn't, unfortunately, that is not a business that is transferable. And if it's not transferable, the value will be diminished, okay? So number five is no growth story. If you cannot explain what is going on in your business, this might be a problem because you might not really understand what is causing the growth of your business or the decline of your business. If it's a black swan event, that's fine, guys. It's better for you to understand and explain than to be ignorant and not be able to explain. Because if you can't explain something, what do people do? They just assume. So number six is weak due diligence prep. You have to have your legal documents, your financial documents, everything that is important in this transaction, you need to have. Because at some point during during due diligence, a data room will be requested, which is documents that the legal side from the buyers need, the financial side from the buyers they need to be able to go through these things here. If you're now chasing this and chasing that and trying to get this information here, it can slow down the process. I'm not saying it will completely kill a deal, but it can slow down a process simply because you're not ready to give these financial documents. If someone says, hey, great, well, we're moving on to due diligence now, you tell them, well, please give us 2 weeks, give us a month, give us 3 months to get this thing in order. You don't know what's going on in the buyer's head, and you don't know the timelines. You don't know the patience. You don't know if they have allocated capital that they have to deploy in a certain time frame. You have to be able to have your house in order, have your documents ready to go. So the most important thing is for you to think like a buyer. Understand, if you weren't in this position looking to sell your business and you were looking to buy a business, what will you be looking for? And all you need to do is reverse engineer that. Think about the risk that you might consider. Think about the fears that you might have. Because at the end of the day, you might be on different sides of the table, but you can understand how the person is feeling if you picture yourself in that scenario. So think like a buyer. Start early. You want to see and hear a growth story. You want to know that this business can run without this person. You want to know that, hey, yes, this one customer, if he leaves, the business isn't completely gone. So it's very, very important that you start early, and preparation is the most important part during this whole process. I cannot emphasize that. Preparation before you even approach one potential buyer or approach a potential business broker. Prepare, prepare, prepare. Because remember, if you're approaching a buyer, they're paying for sustainability, reliability, and profits, right? They're paying for something that's guaranteed or maybe close to guaranteed. Remember, a broker's job isn't transformation, it is distribution. They do incredibly well when it's finding multiple people to buy your business and interested parties. However, if your business isn't ready to be sold, you are not going to get the value that they are telling you. So now that's a complete guide to how to sell your business in the UK. You have access to our resources, our tools within our ecosystem. You have access to our book. That's 120 years of experience crammed into 100 pages. We've given you access to our webinar. Please, please utilize these tools that we've created because we want you to be a more informed business owner. Remember, this will be the biggest liquidity event of your life. For a majority of people, they might only have one time to do it. So do it right. Okay. And if you find this video valuable, please drop a comment, subscribe. There'll be more videos like this in the future. We will do a deeper dive on every single part of the stage on how you can preserve value for your business, because our job at Confabo is to prepare you to sell your business. We do not sell your business. So there's no way that we'll ask you, hey, sign up so we can sell your business. All our job is to prepare you, to give you the best opportunity when you do go to market, because preparation is what preserves value.